Hello, everyone. Thanks for coming tonight. A pretty good crowd. Before I get started, I would like to thank some members of my staff that have helped to put together tonight's program. Christina Schnuckel, who helped with logistics, Joel Driesing, who helped with the presentation materials, Ruben Neese for his technical support, and of course Lisa Edgar, who took hundreds and hundreds and hundreds of reservations as the receptionist. I'd also like to thank my good friends Dick and Carol Richards and their daughter Nancy for making this beautiful hotel possible. They're also clients of the firm. I love coming here year after year. I'm generally amazed when I tell people that the U.S. economy has never been larger, because it normally elicits a response of, no kidding. Or when I tell people that the profits of the 500 biggest companies in America are at record levels, normally elicits a similar response of, really? We're all overwhelmed with negative news day after day. As Spiro Agnew said, the negative nabobs of negativism. When's the last time anybody quoted Spiro Agnew? So my job tonight is to make some sense of all the noise that we hear day in and day out, give you folks a sense of where I think we're going, to discuss, of course, possible and probable outcomes, not only for the economy, but for the financial markets as well. Brian will talk about some company issues after I'm done. Paul Coldigelli will talk about a few financial planning ideas, and then I'll come back at the end of the program to host questions and answers. Give or take, we'll last about an hour and a half. We'll get you out the door, plus or minus around 9 o'clock. We've come a long way in a year. 12 months ago, the Dow was at 11,200, at 13,500 now. We're up almost 21% in the last 12 months. Last November, we finally passed the prior high water mark for GDP in the United States. We set that back in the fall of 2007. Took us till last November, they think. A year ago at this time, when I stood up here, we were technically considered a recovering economy, meaning that we hadn't passed the prior high water mark. Well, we did that last November, and now we're setting new records for the size of our economy. U.S. profits, as I said, are at record levels. We expect to set yet another record at the end of this year. I think what unnerves people is it's the first recovery in U.S. history that's been led by the emerging world. We've never had another one like it, not even close. So we can talk about high levels of unemployment, we can talk about anemic growth in our domestic economy, but much of the world never experienced a housing crisis or a banking crisis. Many of the developing nations have surpluses contrasting to our deficits. The rest of the world is growing quite a bit faster than we are here in the United States. 59% of the earnings came from outside the United States this past year. When I first started managing money way back in 1975, only 14% of our earnings came from outside America. Now it's almost 60%. So you can see on this chart, the high water mark was set in early 2007 for gross domestic product. We passed that last November. The economy expected to hit almost $14 trillion this year for calendar year 2012. Corporate profits, that kind of looks red to me. Probably should look green for profit. But corporate profits after tax, $1.6 trillion. You get an idea of how it sank after 2007, came back, and now, of course, at record heights. So it's this dichotomy, if you will, of record profits for the S&P 500, the largest economy the U.S. has ever seen, yet we have fairly modest, sluggish growth in the 1.5% to 2% range. I think this chart perhaps says it best. If you look at the growth rates in China, United States, and we just group the rest of the world into that top line, you get a sense of how quickly they were growing prior to the financial crisis, how they shrugged it off fairly quickly, and now they're quite a bit higher than they had been just 4 years ago. You get a sense of profits from overseas. Experts suggest that it'll approach 75% by the end of this decade. So fully 3/4 of the profits of the S&P come from outside our borders. It's important to think globally. I'll be talking more about that later in the program. During the financial crisis, the United States faced primarily 4 issues. I'll tell you the punchline, then I'll fill in the data points. Many of these headwinds are dissipating. It'll be a while yet before they become tailwinds, but many of the issues that were holding back the U.S. economy are starting to fade. The biggest problem, of course, was the banking crisis in the fall of '08. It's wrong to suggest that we had markets. Many markets shut down because of TARP, because of the infusion of money into our banking system. By the end of 2009, measures of financial stress were more or less back to normal. The second issue I think we're going to continue to struggle with for a number of years, and that's, of course, deleveraging. For the 30 years prior to 2007, the world created an enormous amount of money. We expanded our capital lines across continents, and now simply we're suffering through a process of deleveraging. When Bear Stearns blew up, they were leveraged 31-1. Now, some of you may know about leverage. What 31-1 means, you give me $1 million, somebody's going to lend you $30 million, and so you have a $31 million war chest. If your account goes down 3%, you just wiped out your $1 million. So that kind of game is not for the timid, right? When Lehman blew up, they were leveraged 32-1. So the simple point here is that for every dollar that gets used to pay down debt, that's a dollar that doesn't go into the economy. So the deleveraging process, fortunately, is maybe 2/3 of the way through the process, depending upon who you're looking at. But it'll be a while yet before deleveraging runs its course. But the gist of it is the hard part of deleveraging is clearly behind us. Be a while before it creates a tailwind, but it's not blowing as hard in front of us. The third point, I think, is significant in that almost every other recovery in U.S. history was led by the housing market. Just about every other one. Now that, of course, was impossible this last time around because we built far too many homes than we could use. So, of course, that led to a collapse in new home construction. Last 5 years, there have been very few homes built in the United States. And recently, we've read that there's 24% fewer homes on the market for sale in the United States than a year ago. And, of course, the Case-Shiller numbers that came out the other day showed that the average house in the United States actually went up in value. There's something that hasn't happened. Went up in value, albeit at a small 2.3%, but the trend is in the right direction. I read a report this morning that showed that housing has actually subtracted 1% from GDP each year for the last 5 years, and that moving forward, it's not a big number, but they think next year housing will create a 0.5% increase to GDP just because of home starts. That, I think, is significant, and that will, of all of the ones that I'm listing here, actually create a tailwind in this next year or so. And then fourth, of course, was consumer spending. Consumer spending didn't stand a chance because most Americans were up to here in debt. As we all know, 70% of our economy is fueled by consumer spending, and consumers pretty much just started paying down their debt. And we've seen significant changes in debt. The ratio of debt to GDP is way down from its peak. And that, of course, sets the stage for stronger consumer spending moving forward. So the conclusion here is that the headwinds that were holding the economy back are dissipating, which will allow the economy to slowly get back to normal. So this gives you an idea of household debt. You can see how it skyrocketed 5-6 years ago and is now down 11% since the peak. Consider the credit card debt at the peak of the crisis was over $1 trillion in the United States. It's now down 17%. It's still a pretty big number. $850 billion is the balance currently on credit card debt in the United States, but it's down quite a bit since the financial crisis. So that's the good news. I'll give you a list of some of the things that I'm worrying about currently. I think first and foremost is the deficit. After soaring to more than 10% of GDP in 2009, the U.S. federal budget deficit has retreated slowly over the past 3 years. From 10.2% of GDP in 2009, they expected it to end this fiscal year, the end of this month, at 7.6% of GDP. The U.S. is on a path, in my opinion, with some tough decisions ahead to regain control of its budget within a few years, a significant advantage to compare to many other developed nations. Reductions in government spending have impeded the economic recovery. Consider that since the start of the expansion, private sector GDP has grown 3.3% annualized a year, and real government purchases have fallen 1.3% a year, serving as a significant headwind to the economy. In my opinion, that won't change. The second point is the fiscal cliff. Some people call it Tax-mageddon, but the point is, under current law, as of January 1st, 2013, all the Bush tax cuts expire, the payroll tax cut expires, and new taxes on upper income households because of the President's Affordable Care Act kick in. In addition, big cuts in discretionary spending are scheduled to begin. Now, the problem is that tax increases and spending cuts of this magnitude would very likely push the economy back into recession. So fortunately, in my opinion, the risk is remote. It's one of the most asked questions that we get at the firm, but there's two ways this is going to play out. One, we get one party that takes it all. So either President-elect Romney or re-elected President Obama decides to kick the can down the road. They're not going to take the responsibility for the spending cuts, let alone the tax increases. Scenario number two is we get divided government. So on the divided government scenario, the Republicans are going to want to compromise because they're not going to want to take responsibility for a tax increase. And the Democrats are going to have to negotiate and compromise because they don't want to see their social programs gutted. So political expediency, for once, should push both parties to work together. So the research that I have access to, the people that I talk to, think the physical cliff won't happen. But it's amazing how many articles you read that say that we're doomed if it does. Granted, no argument there. Many of us feel that it won't happen. The next point is China. I'm worried about China. Their growth has slowed abruptly this year. Now, fortunately, they have the levers of monetary policy to get their economy back growing again. But the slowdown has been fairly dramatic in China. When you take a look at the last issue, it's Europe. Boy, I'm tired of talking about that. So Europe, the crisis is easing, even as the continent is going into recession. In my opinion, the situation remains troubling. And a little bit later in the program, I'm going to be talking about trilemmas to help y'all get your arms around international finance. So you can see the U.S. budget deficit as a percentage of GDP has actually been making progress from 10.2% of GDP to 7.6% just in the last 4 years. Job creation has been a problem, will be a problem. The Fed, as we all know, last Thursday said they're going to keep rates low until the unemployment rate drops significantly. We're making progress, though. Consider at the height of the crisis in 2008, there were 6.5 people for one job opening. Last year, that fell to 4 to 1, 4 folks looking for work with one opening. And currently, they estimate it's about 3.5 to 1. 3.5 people looking for work for every one job opening. Be a while yet before we get back to the peaks that we saw in 2008. As a percentage of adults in the United States, we're to the lowest levels. Only 63% of people work outside the home in the United States. That's the lowest number since the early 1980s. I put this next chart up because it gives everybody a pretty good sense of business spending. Right? It might seem as a somewhat esoteric indicator. What we're talking about here is the amount of plant and equipment currently in use in the United States, capacity utilization. And what we know is that generally at about 82% of capacity, companies really have to start spending because of obsolescence, because of competitive demands, companies start opening up the spigot spending when you get somewhere close to 82%. So you can see the capacity utilization plunged to 67% in the middle of the crisis. And we're heading back up here. We're approaching 80%. Most of the pros think in the next couple of years, business spending, or capital spending as we call it, will start to improve dramatically. The good news, of course, is that companies are awash in cash. As a percentage of their market capitalization, the average Fortune 500 company has almost 20% of their assets sitting in cash right now. Okay, so bear with me on this next one. This is really worth talking about, a little bit involved, but you'll want to stay with me on this explanation. A guy named Robert Mundell won the Nobel Prize in Economics a number of years ago for his theory of trilemmas. And if you take the time and think through this thought, you'll know more about international finance than most folks. So what Mundell showed was that every country wants three things. And at best, you're going to get 2 out of 3. And if you only have 1 out of 3, you don't stand a chance against the folks that have 2 out of 3. So here goes. Every country wants to allow free flow of capital in and out of their borders. Every country wants to control their monetary policy, raising, lowering interest rates, that kind of thing. And every country wants to control their currency. So let's start off easy. Here in the United States, I'll work backwards. We can't control our currency because the dollar's too big. So if we're not careful about our deficits at some point in time, it'll ruin our currency, and that'll be the end of things. We certainly control our monetary policy, and we certainly allow free flow of capital. Now compare and contrast that to China. China doesn't allow free flow of capital. They literally have bureaucrats that assign values to shopping centers and apartment buildings and office complexes. If they're not careful, they're going to create the mother of all asset bubbles. As we all know here in the West, the only way to determine true value is to stick it on the market. That'll tell you what it's worth. And their process doesn't allow that. They certainly control monetary policy, and of course, they control their currency, they peg it. So here's where I'm going with all this. Back to Europe. So in Europe, they can't control the euro, it's too big. They can't control their monetary policy because you have the Southern Europeans that could care less about inflation, and you have the Northern Europeans that are rightfully phobic about price increases. They only have free flow of capital. That's all they have going for them. So Mundell got the Nobel Prize for showing that if you don't get 2 out of 3, you don't stand a chance against the people that get 2 out of 3. Right? So it sounds complicated. In my opinion, it's not. We're talking about allowing money to flow in and out of countries, allowing countries or economic blocs like the Eurozone to control their monetary policy or try to control their currency. So here's why I'm telling you all this. Short term, I think putting their finger in the dike in Europe is going to work. You know, I read something that a guy named Bill Gross wrote from PIMCO last week, said that, you know, the real issue is who's going to pay for it all. So the Southern Europeans don't have the money, they're broke, that's the whole point of this. That it really is Germany and France, they're going to have to get their checkbooks out. And Germany, of course, is reluctant to give up some of their sovereign rights, so that's what they're pushing and shoving about right now. But long term, it's doubtful that the Eurozone will stay intact because of what Mundell showed. You got to get 2 out of 3 to get it right. So, my opinion, the economy is going to slowly improve over the next couple of years. The headwinds are fading, as I mentioned, and certainly lower interest rates will help growth not only in the United States, but overseas. If you look at the far right side of this chart, you can see that this year we expect GDP to be somewhere around the 2% range. Pretty hard to say, although exports are increasing right now. That'll help the GDP in the fourth quarter. We're projecting 2%, 2.1 next year, and then a little bit higher, 2.7% the year after next. These numbers, you may be able to see this on your chart, come from the Bureau of Economic Analysis and Bloomberg projections. Economic research, including work that led to a Nobel Prize, has found that portfolios can reach an efficient frontier in the balance between risk and return, at which the potential return flattens out even as the risks keep growing. Folks, this is one of the smartest things I ever figured out. This has kept me and you out of all sorts of trouble over the years. And it's the one thing most investors struggle with, is what's the right amount of risk? And of course, what we study is at what point is the next incremental increase in risk not worth the reward? And for those of you with good memories, because I like rolling this chart out every year, as you know, did it ever dawn on you that the chart doesn't change? So these are 30-year look-backs. Year after year, they go back 30 years. And it doesn't change. What's cool about this year is that it starts in '82, right at the cusp of the bull market. And it still didn't pay to have much more than 50% in stock. So, of course, I've got to step you all through this. At 100% in bonds, it's the lowest return. That's the blue balloon down at the bottom. It's not the lowest risk. What a great horse trade. By introducing 20% in stocks in your account, I get to tell you I'm reducing your risk and increasing your return. What's not to like about that? So I dial it up to 40% in stock. I don't get to tell you anymore I've reduced your risk. I haven't. But I've given you the same increase in return commensurate with the additional risk that you took. And then, of course, the point of all this is that the efficient frontier studies show that you get much past 50% in stock, your risk line keeps going up, your return line flattens out. What I love about this 30-year look back, of course, is that if you go up to 100% of stocks, you actually lost return. So normally that line flattens out. Thank you, Paul. Rip this out of your material, tape it to your refrigerator, and leave it up till next year. Because this will get you through those dark days when we get sell-offs in the market. Because this is what it's all about, is focusing on your risk. We pay more attention to risk than we do return at the firm, and get a sense of what your balance should be. Now, to jump this to the graduate school level just for a minute, we like to study correlation theory. This one sounds complicated. It's not. It's pretty easy to talk about. Correlation theory, of course, is the study of how assets move relative to one another. And the trick is to introduce as many lowly correlated assets as possible to your portfolio. Right? So this chart shows, look down to bonds as an example, and look at the large stocks. It has a fairly low correlation. Right? So bonds march to a different drummer than stocks do. So really what we're trying to accomplish is, if something in your account gets whacked, you want something else doing this, so that on balance you're going to do okay. So we're constantly looking at asset classes that have a low correlation to one another, because it's one of the best ways to reduce the risk in your account. It's not numerical diversification, it's diversification by correlation. Now, here's the tricky part. Correlation is heavily dependent upon economic conditions, meaning the last 25 years we've had relatively low inflation and fairly strong economic growth. So that reduces the correlation between stocks and bonds. And that's been my mantra for the better part of almost 3 decades. Reduce the correlation as best you can. I mean, think back to the year 2000. It wasn't that I got clairvoyant. It wasn't that I was predicting that stocks were going to get creamed for the next 10 years. It's that I understood this. I understood correlation theory. I never would imagine that we would have done better in bonds for 10 years than we did in stocks. I never even made that call. What I did do was understand correlation theory. So here's the hard part. Moving forward, the pros are forecasting gradually rising inflation as the central bankers around the world reflate. That'll gradually push up inflation. So here's why I'm telling you all this. Not now, not tomorrow, not next year. But most of you in this room are going to want to slowly introduce non-traditional asset classes as a way to reduce the risk in your account. And there's only 3 ways to get there. Treasury inflation protected securities, real estate investment trust, or some type of commodities account. Only 3 ways. Now, some of our larger portfolios, we've already started introducing some of these, and it's not a rush here. But over the next couple of years, as inflation gradually takes hold, we're going to need to introduce some non-traditional asset classes. And if we're lucky, we're going to make more money and reduce risk at the same time. That's harder to do than it sounds. And if we do it the right way, we'll certainly reduce the risk because your bonds are going to start tracking more like stocks. So as I'm sure all of you know, it's all about interest rates and earnings. Only two things that cause stocks to go up or down. And here the news is fairly good. We set a record in 2007 in the United States for S&P earnings at $88. That took the Dow to 14,000, 2007. Took us until last year to pass that. We hit $97, give or take, at the end of last year. This year, we're expecting an 8% increase in corporate profits to $103, $104. Next year, according to Bloomberg, these are consensus forecasts. So they take over 800 analysts in the United States. They throw out the high numbers, the low numbers, and come in with a consensus. And currently, it's $104 for the end of this year. But more importantly, this year is baked in the cake. Look at next year. They're anticipating an 11% increase in profits year over year, and potentially we're heading to $116. Excuse me, kind of fuzzy to look out the year after next. Still a big number, folks, with an 11% increase as well going into 2014. So here's the gist of this chart. Stocks are cheap by almost any measure. Now, when I say cheap, we're talking about relative valuation. Stocks are cheap relative to interest rates, stocks are cheap relative to earnings, and certainly stocks are cheap relative to inflation rate. Could get cheaper, but stocks are historically very cheap right now. We quote price-earnings ratios two ways, looking back or looking forward. Historically, what you read are trailing 12-month earnings for the PE. So as you can see on the left side of this chart, for the last 30 years, the PE in the United States has averaged just a tad over 18 times 12-month trailing earnings. Today, we're under 15. More importantly, as I said, this year's baked into the cake. Most of the pros are already looking into next year, and we see on a forward basis the market selling at roughly 13.5 times earnings. That's cheap all day long. What I think potentially is in the cards is the possibility of an expansion of the multiples. So what that means is, if we just go back to average PEs, the market potentially could go up another 15 to 20%. Be talking more about bonds in a little bit, but folks, we're heading towards a no-yield world, and more people are going to start looking at the dividends in the market as opposed to the puny interest rates available in the bond market. So stocks are cheap right now. I threw this one in just for fun. You know, there haven't been many 10-year periods of time where stocks have lost money. We just lived through one. The brownish colored part on the chart is the result of 10 years of a down market. And the blue box to the right is what happened to the stock market in the 10 years after that. So as you can see, we've only had 4 sell-offs that lasted 10 years, going back 100 years in the United States. And every single one of them had really nice returns afterwards. So I'm not smart enough to tell you how this one's going to play out ultimately. My guess is it's going to do pretty well. So most of you are familiar with the 9 style boxes according to Morningstar. Upper left-hand side is value, right side is growth. Simple definition, of course, is value stocks have below average PEs. Growth stocks just the opposite. They have above average PEs. Middle row is mid-cap stocks, middle-sized companies. The bottom row are small caps. What's interesting about this chart is that there's very little divergence between asset classes. So this speaks to the issue of the risk-on, risk-off trade that we've seen all year. Not a stock picker's market. It's people pouring in, people pouring out. Historically, there's an 11 percentage point difference between the best asset class and the worst in a given year. Look at this one. There's very little difference between the various asset classes. I rarely see this in the market at this point. This one's real current here. This is through last Friday. So very little divergence. That tells us that there's wonderful opportunities for stock pickers moving forward as we get away from the risk-on, risk-off trade. As we've seen since the end of July, early August, market's up almost 7% since then, and it's become more of a stock picker's market that's good for actively managed portfolios. So this next chart tells you all sorts of things. What you're looking at is current PEs as a percentage of their 20-year average. Okay, so current PEs of these asset classes as a percentage of their 20-year average PE speaks volumes. Look at the growth column. I love growth stocks now. Growth stocks do really well when the economy is expanding slowly, better than value. And the point, of course, is they're a bargain. So large cap growth stocks are selling for 65% of their 20-year average PE. Now, even if you strip away the PEs of the late 90s of the growth stocks that got into the nosebleed territory, growth is still a bargain relative to value. And every time I ever bring this up, I potentially create the impression that I want you all to leave your value funds and go to growth. That's not what I'm saying here. I'm talking about on a relative basis, growth stocks are very attractive. Many of you in this room have a little bit more in growth stocks than you do in value stocks. That's a little bit different than you've seen historically. I'm worried about the small caps, particularly in the value and the blend area. They're pretty expensive, so are the mid caps. Pretty unusual that you see bargains in the growth stock area. And you know, last year when I showed you this slide, growth stocks were selling for 75% of their long-term PEs. So that's gone down 10 percentage points in the last 12 months, despite the fact that the market's up almost 21% from a year ago in September. So I'm showing you this slide for a couple reasons. Many of you know that U.S. stocks have outperformed international stocks for the last 3 years. I think that's about to change. What you've seen is money pouring into the U.S. dollar as the financial crisis really took hold. You need a dollar that's weakening to make money overseas. Halfway through the year, the stock market was up 10%. Many of the international funds were up 5%. And so now they're closing the gap. International is just a percent or so below domestic stock funds year to date. And my guess is sometime next year, they'll pass. 52% of the world are U.S. securities. So that means in English, 48% of the action is outside our borders. Of the top 50 wealth managers in the United States, the average recommendation is for 15% international. Most of you have that. Some of you have even more. So to completely nail down the point, if you look at the left side of this chart, it shows 60% in U.S. stocks, 40% U.S. bonds, no international exposure. So look at the return, 9.5%. Look at the risk as measured by standard deviation, 11.2%. You look at the right side of the chart, we've introduced then 13% international stocks. So this is a pretty good horse trade, folks. You make a little bit more money and you have less risk. That's the whole point of correlation, is to try to make more and reduce your risk. So it wasn't by a whole lot, but the fact is you were able to make more and take less risk by introducing a different type of asset class from just doing U.S. stocks. As I mentioned, I like growth stocks over value, given the economy is likely to remain in a modest growth mode. Low interest rates and low inflation historically are very good for stocks. That's what we have now. Company dividends and share buybacks are at record levels in the United States. I like higher dividends. I like share buybacks. They intend to increase prices per share. Sentiment is low. That's a really good contrary indicator. Most retail money is going into bond funds, as most of you know. 1990, in a conversation that I had with Don Phillips, the guy that started Morningstar, we were talking about tracking flows of funds in and out of categories. What he figured out was that, I love this study, that you want to invest in categories that have had net redemptions, right? And you're not going into categories that have done poorly. You're going into categories where a lot of money has walked out the door. And so we know that this year, over $200 billion of new money has gone into bond funds, and we've had almost $60 billion walk out of stock funds. So you want to do what everybody else isn't doing. The wonderful contrary indicator. We know that dividend yields now are higher than the 30-year Treasury. You have to go back to the 1950s to find a period when yields on equities exceeded those on bonds. Finally, large cap stocks are among the better prices we've seen in almost a decade. It's unusual when you get some of the best companies at some of the lowest prices. Of course, we could get a pullback. We had a 20% sell-off last year from April to October. We had a 10% pullback late this spring. And of course, stocks are meant to be held long-term. But in my opinion, equities remain historically cheap. And please make sure you have adequate equity exposure in your portfolios. Last Thursday, the Federal Reserve Board announced its latest plan to stimulate the economy, saying it would buy large quantities of mortgage bonds and other assets until the job market improves substantially. This is the first time the Fed tied the duration of its program to its economic objective of reducing unemployment. The Fed also said that they would leave interest rates low until the middle of 2015 instead of the end of 14, as I said earlier. The Fed expects the economy to grow about 2% this year and a little bit higher than 2% next year. Now, of course, the quantitative easing is meant to drive down long-term interest rates and push investors into other assets like stocks. It's also expected to weaken the dollar, which of course happened since last Thursday, which will help U.S. exports. Lower rates will help the housing market. Consider that the 30-year fixed mortgage now is heading toward an all-time low of 3.5%. I can remember I assumed a VA mortgage in the 80s. I was thrilled we got 12% on the mortgage, and I felt very lucky to get my house. So 3.5% money for fixed 30-year mortgages, that's a deal. Now, it's clear that many of the economic problems are beyond the reach of monetary policy and the Fed. The Fed cannot force the Congress to budget. It cannot repair consumer credit, nor change Europe into something more sensible. I wrote an article on the website maybe 2 months ago talking about how we're heading to a no-yield world. So what that means is you're not getting interest on your checking, you're not getting interest on your savings, you're not getting interest on your money market funds either. It's called financial repression. Retirees that are trying to live off their savings are basically subsidizing the idiotic ways of the banks. So as interest rates come down to zero at the short end of the yield curve, what's happening is that it's forcing investors to increase their durations, extend the maturities, and to decrease the credit quality of their bonds in an attempt to get more interest. As interest rates go lower, it increases duration risk or the vulnerability of bond prices to any rise in interest rates. And of course, such interest rate sensitivity is at record highs for many types of bonds. Even a modest uptick in interest rates could negate returns at this point. It's now even harder to reach for yield without adding more and more risk. So here's why I'm telling you all this. It's important that investors position their portfolios properly in advance of eventual higher rates as the economy strengthens. Not today, not tomorrow, perhaps the year after next. The risks that currently come from being overweight in high-quality fixed income exceed the reward after a 30-year bull run in bonds. Let's say on the chart, the Barclays aggregate U.S. bond index yield at 2.2% is the lowest ever. In the short term, we're heading for a no-yield world. If you didn't read the article on no yield that I wrote, go to the website. That'll give you some more detail. So this chart, of course, shows where we've been. Gives you a sense of where we're going. Interest rates have been heading down for the better part now of 32 years. I spoke last year of the difference between secular trends and cyclical trends. So a secular trend is a long-term pattern. In the last 32 years, rates have been basically going straight down. Every now and then they get interrupted by a cyclical change, as we saw in 94, as we saw in 99, as we saw in 03, and as we saw in 07. But as rates go to zero, basic common sense is going to tell you that at some point in time rates have to go up. And that's the point that people are going to have to be careful. A lot of investment firms got this one wrong. We didn't. 4 years ago, the op-ed pieces of some newspapers were loaded with articles saying that inflation had to skyrocket. I held my ground. I knew it wouldn't. The economy was far too weak. The multiplier was broken. When banks lend money, we typically multiply the effect of the money they lend fourfold, right? Only the banks are afraid of their own shadows. They meow that the regulators are breathing down their neck. They can't find qualified borrowers. The fact is they're not lending. And until the banks start lending, that'll happen eventually. The multiplier can't kick in. Inflation can't happen. So inflation is fairly low right now. The core rate is below 2%. That's the point at which the Fed starts getting twitchy on inflation. But the core rate's been quite a bit below 2% for this year, last year, next year, the year after next, and even the year after that. They're predicting that inflation will stay fairly low. So you don't get the wrong message. At some point in time, inflation has to go up, has to. But I don't think it's imminent, but we're going to have to start getting ready for it. I like municipal bonds, always have. We know that historically municipal bonds sell for 80% of the underlying treasury rate. So I'm showing you this chart just for a simple reason. Today they're at 105% of the underlying treasury rate. Municipals are a bargain. So you need to think outside the box right now in bonds. Look at high yield bonds. I like the low end of investment grade. It's still possible to get 6% or more on your money. Municipal bonds, I like. Tax-free, I hate paying tax. Sovereign debt, there's been much written about that. One of the world's largest bond funds now has almost half its money in sovereign debt. They've done pretty well this year. Mortgage-backed bonds, of course, because of the housing market come back. Even some of the non-agency mortgage bonds are attractive. And emerging market bonds, we've done pretty well on those this year, despite the stronger dollar that we saw up until about 6-7 weeks ago. So emerging market debt also looks attractive relative to treasuries. But here's the point I want you to all remember. Seeking yield by extending durations or reducing quality will alter the risk-reward ratio in fixed income investments. This is a miracle. I was supposed to talk for 45 minutes. This never happens. Purely accidental. So I'm going to come back and host questions and answers. Got a couple of other things on my mind. We certainly appreciate our relationships with everybody here. Thank you for your business. Thank you for your time tonight. We'll look forward to seeing you at the firm. Thank you, everybody.